Thank you, everybody, for joining us today on our special edition of our Criterion Learning Series. We're going to be talking about some of the changes in the Secure Act 2.0 that was actually passed last year in December. And most of these changes do not actually come into play until later on. Some things go into effect next year and then further out, 25, 26, 27. And I'm going to do a high-level overview of what's in there that's going to affect some employers, perhaps affect your company. Of course, what we do want to mention is that if you do have any further questions about this, how it might affect the taxability of deductions, especially not really incomes in this situation, but deductions, please contact an accountant, tax advisor, or tax consultant. We're not able to provide tax advice. What I have down here is information from the regulations that went into play. If you have a different interpretation of them, please do reach out to somebody who's more of a tax authority than I am. All right, so let's talk about what is going to be going into play and what's happening in, whatever years they're happening in. Like I mentioned, there are certain things that are happening in 25 and 26 and further on as you look out into this thing. Obviously, we have some time to look at this and to implement it in the system. The nice thing, of course, is that you'll have time to test it out, use your sandbox environment to set it up. If there's any changes that we need to do to handle certain things, maybe there's a new deduction type that may not be visible within our system until we get closer to the actual effective date of whatever that particular thing is. So when I talk about things now, remember, like I mentioned, these might be a year or more away. So just be aware of these things as we talk about them. So the first one is automatic enrollment requirements. So beginning in 2025, employers who start new retirement plans will be required to automatically enroll employees at a rate of 3%, but not more than 10% per year. So if you are an existing company, which you are right now, depending on the age of your company, you will have to automatically enroll your employees in a retirement plan. If you're a new company, started this year, or you're going to be less than 3 years in 2025, or your company with 10 or fewer workers, I don't think any of our clients on here are that way. But if you are excluded from that requirement, so you don't have to do that. And employees do have the option to opt out, so they can opt out of that, but you are required to enroll them unless they opt out. What we'd probably recommend is having some type of form that they would fill out to opt out. So if you do need help setting up a form, our support team will be here to help you out with that. Obviously, we have a little bit of time here. This one's not until 2025. So just think about how that's going to work. All right, so next we're going to be talking about expanded catch-up contributions. And some of these do come into play in 2025, and other things you see here is 2026. So starting in 2025, the catch-up contribution for participants who are aged 50 or older, they can contribute an extra $7,500 annually to their 401k. All right, that doesn't really change too much compared to what they're doing now. The deduction setup and so forth is basically going to be the same. If you already have a catch-up contribution, basically just means the limit is changing to $7,500, not next year in 24, but a year after that in 25. All right, and then if you do have a participant who's 60 to 63, it actually increases to $10,000 per year. So you'll probably want to have a separate deduction for them in that, in a year and a half or so when it becomes effective. That'll be $10,000 per year. And we'll probably have a new setting in there for deduction so that it will properly go up to $10,000 for them. Now, these contribution or catch-up provisions will be indexed for inflation. So similar to they are now, it changes every year. You're probably aware of that. The catch-up has been going up slowly every year, maybe $500, maybe $1,000 per year. But so that's going to continue on, and you see the numbers for that. And then effective in January 26, this actually got pushed back. All catch-up contributions for participants who are earning more than $145,000 in the previous year must be made on a Roth basis. So they don't have the option to do a pre-tax basis like they do now. It must be made on a Roth basis. And again, that's something that is 2026. So you got a little bit of time, make your employees aware of that. Maybe the IRS will push it again. I don't know. They did push it already. When they announced that in August, they pushed it. So we'll see if it possibly might push. Keep an eye on that. And of course, we'll keep people up to date. Obviously, we do have some time to look at this, and if they make another change, we'll know about that. All right. Other things that may impact your employees, just be aware of this, that long-term part-time employees will become eligible for retirement plans sooner. So with the Secure Act 1.0, they actually became eligible if they worked between 500 and 999 hours after 3 years. And now it's going to be going down to 2 years. So in 2025, if you do have anybody who's a long-term part-time employee, as you see defined there as working between 500 and 999 hours for 2 consecutive years, they will be eligible to participate in your retirement plan. All right. There's going to be the federal Savers Matching Program is going to be eligible for low to middle income employees starting in 2027. And that is currently defined as people who are earning less than $71,000 per year. They're going to be eligible for a federal matching contribution of up to $2,000 per year that you must deposit into their retirement savings account. And this match will phase out based off of income and tax filing status. It replaces the existing Savers credit. So if you're currently doing this, it's going to replace it. You obviously have a little bit of time. 2027 is when this is coming into play. So you'll have time to implement this, but this is going to be a new regulation there for $2,000 per year. And last, but certainly not least, for many people, is beginning in 2024, student loan payments could count as retirement contributions for the purpose of qualifying match contributions for a retirement account. So employers will be able to make a contribution to their employer retirement plan, a company retirement plan, on behalf of the employees who are paying student loans instead of saving for retirement. So you'll be able to make that contribution for them, your employer match basically for them. The matching contribution for student loan payments must vest under the same schedule as other matching contributions, so whatever your vesting schedule is. And additionally, of course, the employees must be eligible for the match in order to receive it. So if they're not eligible because maybe they're part-time or something, they wouldn't be eligible to receive this. But if they are, you can make a contribution for them if they're making student loan payments. All right, so that is an option for you as well. So those are all things that affect you as an employer. Now, there are other things with the Secure Act 2.0 that affect people who they already have money set aside and they're doing their distributions and so forth. We're not going to cover all that. If you're interested in that information, you can certainly search for that. I did read all about it, but it's nothing to do with us because we don't do any type of things with IRAs and stuff like that and distribution. So there's a lot more to it that you might be interested in looking at. Now, what does this mean as far as the system is concerned? I do want to show a little bit on how you can set some of these things up in the system. So you can see how to, for an example, set up a catch-up if you don't have one configured already. So let me switch over to my browser here. And one moment. And I do apologize. I've been having some problems with Zoom, so hopefully it switches over without issue. And all right, looks so far so good. So you should be able to see my self-service here with our little image of Secure Act 2.0. And what I'm going to do is I'm just going to go over to the settings just so we can talk about how to set up a catch-up contribution. And of course, enrolling people in 401k, there's different ways you could do it. You could set it up as a benefit plan, and maybe people go through open enrollment and they can put in their percentages and so forth. If you want to set it up that way, you can link it to a deduction. Of course, the match is calculated in there. You don't have to set it up as a benefit plan. Many companies do, but you don't have to do that because you can just set it up as a deduction and then add the deduction to the employees and so forth. So one of the advantages of setting it up as a benefit is you can set it to automatically enroll people. So those requirements for automatically enrolling them, that's going to be coming into play. You might want to use a benefit plan for that. If you already have it set as a deduction and you would now like to start it up as a benefit plan, you can add the deduction, the existing deduction, to a benefit plan that you create now or when you get closer to when you're required to enroll people. But let's look at the deductions. All right. Now, I'm going to look at a standard 401k, just so you can see what what it's going to look like if you're doing just a regular 401k, not catch ups or anything like that. So the code and description, I made mine very generic, just 401k. You might call it like 401k percentage and 401k amount, because maybe somebody does a percentage, other people do an amount. Of course, if you're doing a Roth, you may want to call this Roth 401k. That's completely up to you. Remember, the description is what somebody's going to see on their pay stub. So it does not need to match the code. The code could be different than the description if you like. All right. The important thing, of course, is this deduction type. You'll notice we have different deduction types in here. So what you do not see right now, but I'm sure is going to be added before it comes into play, is for the catch up for people who are over 60 when they're able to do the extra amount. I think it was 2026. I apologize for not remembering the date, but when they're able to do that, we're going to have a new deduction type in there, I'm sure, to handle that new amount. So that's starting in 2025. So we do have some time on our end to work on it, but that'll be there. I'm sure we'll announce it when it's available so you can start using that. So you'll see for a regular 401k, you're just going to use 401k deferral. It doesn't matter if it's a percentage or amount. If you are doing a Roth 401k, setting that up, you'll see you don't actually need to do anything, because it is Roth, but you could mark it as a Roth. Roth is basically means that it's after tax. This will allow it to show correctly on the W-2 though. So you could, if yours is currently set up and it doesn't say Roth, it maybe just says post-tax, that's okay, but it won't show correctly on the W-2. It will still treat it as a post-tax. So or right there. And then what you see when you go down is the limit. Now, I haven't updated my limits in a while, so ignore these limits, but whatever the limit is for the year. So obviously you'd want 2023's limits in there right now until the end of the year. And then starting in January, put in the new limits for 24. I apologize, I don't know what they are right off the top of my head, but I'm sure it's like 24,000 or something like that. But you put that number in there. And then the employer match limit, whatever that is in there. Now you may have multiple 401ks, like I said, a percentage and an amount and a Roth and so forth like that. So you might have like 4 different 401k deductions set up depending on whatever people are electing, in which case you might have ones that are pooled together. So there's a checkbox up here called pool. And when you do that, that allows you to group together multiple plans. Now, I have only one 401k set up. In fact, let me set up a second one just so you can see what will happen here. I'm going to use this one as what I'm going to call the pool, the parent. That's what we call this, the pool parent. And I'm going to set up a Roth 401k just so you can see what that looks like here. Roth 401k, I'm going to use that as the description. All right. And then just regular and supplemental. Of course, that depends on how you have yours configured. If you have questions on this, let us know here. Maybe you'd use an off cycle. We're not going into the details of exactly how a deduction is set up here. And I'm going to do percentage and match. This is employee and employer. All right. Bi-weekly, I don't remember what the other one was. I'm not worried about that right now. This is going to be a life amount per year. You might have a separate limits for employee and employer. I'm going to put 19 because that's what it was on the other one. I know it's not 19, but I'm just matching up what I currently had. Now here, I'd want to select the 401k as the parent. So I want to select the same parent for all of the deductions that I'm putting together. So if I had a percentage and an amount for 401k and a percentage and amount for Roth, I need to pick one of those as the parent. Doesn't really matter which one, you just need to pick one. And then the other 3 all need to have that parent in there. What that means is if somebody switches and they go from amount to percentage, they've already had, let's say, $15,000 in the amount, they switch to percentage, we're still going to respect that same limit, that $19,000 for all of the deductions. So it would only withhold another 4 in the percentage one. And if they had amount and percentage, or they did a Roth and a regular, it will have a shared limit of whatever it is, 19,000 in my example. And then once it hits that 19, it will stop. Doesn't matter which one happened to hit the 19 first, it's just going to stop. And then, the next year it'll resume, but it won't continue that current year. All right, so that's how you set up a regular 401k. Let me show you how you would set up a catch-up 401k. All right, so you'll see here we've got CU over 50. There we go. So I'm going to call this 401k CU. All right, now this one is a little different because we're going to tell it to start after the 401k. So once it reaches the 19,000 limit in mine, it's going to start this deduction. All right, so I want to make sure this is here so it will start when the other one finishes off. All right, I'm going to just go and just check some of these other boxes here. Now you probably would pool this one again because you might have an amount and a percentage and a Roth and so forth. So you probably would want to pool these. I'm not going to set up the pool because I just talked about it, but you would set these up, whatever they are. And whatever the limit is this year, I apologize. I don't know it off the top of my head. I'm just going to put 5,000. All right, and so there we go. Now so what this means is once it hits that 19,000, this one would start and it's going to continue for the additional 5,000. And then once that 5,000 is met, it's going to stop. If I had pooled together a percentage and an amount CU, and maybe they were doing both of them, of course, it's going to respect the 5,000 for the catch up for the multiple deductions as well. All right, so that's how that works. Now, for a Roth 401k catch up, what you'll see is we actually do not have one in here for that. So what I've always used, and maybe Connor or Patrick can tell me if I'm wrong, is I do post-tax and I put the limit in there. It is after tax. What you then need to do, of course, is put a system label on it to tell it to go into the right boxes if you need to report that on the W-2. All right, now the other types of deductions that we have there, like the savers and the college, the match on that. Now, what you can do is you could have a separate deduction for those. So you may not have it as set up as, let's say, 401k as your deduction for that. Maybe you do a separate one just to make sure that it's separate. The employee understands that this is the savers credit or this is the college loan repayment match, that kind of thing. So you may want to set up a separate deduction for that to have your match over there. Now, this match contribution, let me go back to this one. This, of course, is whatever your match contribution is. In my example here, this is saying we're matching 100% up to 3%, and then the next 3% we're matching 50%. Your match may be completely different than mine. If you have any questions on how that works, please reach out to our support team. We're here to help you and answer that questions on how that match works. This, 100% to 3%. So once I get that 3%, it's going to drop down to 50%. And then once it reaches the combined 6%, 3 plus 3, it's going to stop the match. So that's how mine is going to work there. Yours might be different. Maybe you do 100% to 10%. Who knows? You could have your match over there. So the same type of thing would apply with like a savers credit. You're doing $1,000 or $2,000, and you're doing the student loan. You might have whatever your match is over there. So make sure you put that in there, the correct match. And if you have any questions, please feel free to reach out to our team. All right, how do you reach out to our team? We always like to bring this up. So you can always hit the help center right here, and you'll notice the buttons or the down here. There's our email address, our phone number. That's how you can reach out to us. That's probably the best way is to call or email us. You can also submit a ticket by clicking here and adding a ticket. So that will directly put it in our ticketing system. It's basically sending us an email, letting us know that, hey, there's a question about whatever the situation is. This help will also give you help on the deduction setup. So if I go into a 401k, as an example, it's going to explain what all the different fields are. So it gives you some examples here. We even have some examples of matches and so forth in here. So if you go down, you'll see certain things. Like, oh, I want this to show on box 12C for, W-2. Now that's probably not the right one for 401k. But if you wanted to go to a certain box, you can use the labels for that. So the system labels are used for showing stuff on the W-2, and of course you can see in here how to set those up. Let me go down to common matches, so things like 401k and Roth. Of course, if you got multiple of those, they share a match. You have a checkbox for that. And then here's some examples of how you do a percentage match on here. So saying 100%, 6.33, and then 50% to next 3.2. So you see some examples of how that all works in there. If you do have questions on those things, you can always go to the help center and do searches as well. Now, if you happen to be working with a partner The only difference on this screen is it'll have your partner's contact info down here. So it might say help@partner.com, whatever your partner is, and it'll have their number. This is ours. And if you do call us and you happen to be working with a partner, we will redirect you back to your partner, and they may reach out to us if they have any additional questions, or if there's a problem, maybe there's something that we can't do, or you're saying, well, I don't see that thing for that when they're 60 to 63, and your partner can't add that in. That's a thing in the system. We will work with the partner when that gets added, let them know and stuff like that. All right, so that should basically cover what we need to know about the catch-up, the Secure Act 2.0. As of right now, I do highly recommend you pay attention to these things. The IRS might change dates again. They did move things around already a month ago, or now about 2 months ago. So just be aware that things may change. What you saw today might be different a year from now. Maybe they bump it out another year or something like that. And of course, the limits out there, you want to pay attention to your limits for 2024 for 401k and so forth. So make sure you're paying attention to those things and having the right numbers in there for the next year. And of course, as you get to 25 and in the future, keep an eye on those things. We do have our year-end training where we do talk about those. So I will have those numbers memorized by the time we do our training here next month. So if you do want to join and talk about how do you update those things and so forth, we will have our training next month. So speaking on that, let me go back to our slideshow, talk about our schedule of events here. I have not updated the dates here outside of what, if you join us on Tuesday, we've got our next two out here. We still are looking at November and how we're going to do our year end. We will have two for the US. We'll talk about ACA reporting and stuff like that, just like we did last year. It's basically going to be very similar to the webinars we did last year, but we're going to update it with the numbers for 2024. So, look out for that. We will, of course, keep you up to date on that. But in a couple of weeks, we're going to be talking about employee management. So that's mass hires, mass terminations, mass leave of absence, that kind of stuff. Leave of absence specifically, we're going to be talking about at the end of the month on Halloween, on 31st. So we'll talk about that. So I'm going to go ahead and end this a little bit early. I don't know if there was any questions that came across in the Q&A. If there were, hopefully our team got back to you. If you do have any questions, of course, reach out to us. Again, I'm putting our number and email address there. If you're working with a partner, they have the same information. So I'm sure you have their contact info, and you reach out to them if you have any questions. So thank you so much for joining us today. I do appreciate your time and joining us for this special edition of our Criterion Learning.